Hello, ladies and gentlemen. It is 10:59, and we're going to start in about 1 minute. We have a lot of people who have registered, so we're going to give everybody a chance to log in. So hold tight, and we will start shortly. All righty, everybody. It is 11 o'clock, so let's go ahead and get started with today's 1031 Exchange webinar. So thank you all for taking a little bit of time out of your day to join us to learn about 1031 Exchange. I do have a couple announcements to make before we get into the kind of nitty-gritty of today's presentation. So first and foremost, there are a couple options on how you can listen to this webinar. The best audio quality that you're going to get is if you dial in to the telephone line that was given to you. You can certainly listen to me through your computer, but I have heard that sometimes the audio doesn't come over great. So if you want the best quality audio, please dial in using your telephone number with the telephone number that was given. And second of all, there are going to be several slides that we're going to go through in today's webinar. So I have actually uploaded the PowerPoint presentation that I'm going to give you. You can access it by clicking the handouts button on your webinar control panel. So everybody, if you want a copy of today's presentation, it is available to you. All you have to do is click that button under your handouts section on the webinar control panel. And then last but not least, I do have the ability to answer your questions. I don't take verbal questions though, because it gets a little overwhelming. So the way that you can ask a question during today's webinar is simply type your question in to the webinar control panel section that says questions. And it will pop up on my computer screen, and I will answer all of your questions as they are appropriate. So some of you may ask a question at the beginning of the presentation on a topic that I'm going to cover towards the end. So don't think I'm ignoring your question. I will stay on the conference call for as long as there are questions and try to answer everything. So if you do have questions, go ahead and send your question over to me. And I've got one question already. It says, will this webinar be recorded, and will you get a copy of the recording? Absolutely. So what we do is we record all of our webinars, and then we post them to our YouTube channel. And then at the end of the presentation, we will send out a link to that recording. So you'll get a copy of the entire presentation as well if you want it. All right. So with that, let's go ahead and get started. So we've been doing a lot of webinars, ladies and gentlemen. We can't get out of our offices and leave our town. So we've been connecting to the real estate community through these webinars. We've been doing webinars actually for about 10 years. So we've got a really good system in place. And usually we get about 20 or 30 people that log on to our webinars. Today we have over 200 RSVPs. So we're getting a lot more people who are joining our webinars. And I think it's fantastic because what's happening is you're using this time to better your knowledge about real estate and real estate investing and the tax laws that affect real estate. So the work that you're putting in now, developing your skills and sharpening your skills, they're going to pay dividends going forward because we're going to come out of this, and the people who have sat around watching Netflix and eating ice cream, they're going to have a hard time competing with you. So I am getting someone that says there is no sound. So if you can't hear me again, the best way is to dial in to your to the audio via the phone number provided. Sorry, I'm just going to reply to this. Okay. So let's go ahead and get started. My name is Leonard Spoto, and this is me here. Today we are going to talk about the advanced strategies behind 1031. So we're going to go over some of the fundamental basics, but we're going to go over a lot of the nitty-gritty, from calculating your taxes to figuring out what gain is and your basis and all that. But before we get started, I do want to make one quick announcement. This is probably what everybody's really interested about. You guys have heard about a lot of the taxpayer relief programs that are coming down because of the coronavirus situation. The bad news in the 1031 exchange world is that as of today, April 7th, we have not heard from the government regarding any extensions of the 1031 exchange timeframes. Now, a couple of weeks ago, I've been giving these presentations for a couple of weeks now, and I was telling people that extensions are very likely. Well, I'm getting a little worried, and so I've crossed out the word likely, and I'm telling people now that extensions are possible. Now, I hope that the government is just backlogged and they haven't got a chance to get around to 1031 exchange, looking at 1031 exchange taxpayer relief yet. And I'm hoping that when they do, they're going to say, yeah, absolutely, we're going to give people affected by the coronavirus who are in a 1031 exchange extensions. Now, in the past, they have given relief that included 120-day extensions on the timeframes. And that has been for the hurricanes that we've had, for the wildfires. If you were directly affected by a natural disaster, the government came in and said, hey, we're going to give you more time. And in the past, it was 120 days. So we expect that if we get relief for taxpayers who are affected by the coronavirus and the shelter-in-place programs that we have around the country, that you're going to get at least 120 days. Now, can I guarantee that that is going to be the situation? Absolutely not. Can I guarantee that the IRS is going to give us more time? Absolutely not. Is it likely? Well, I was saying it was likely, and now that every day that goes by, I'm saying, well, it's definitely possible. So we are going to let you guys all know as soon as we hear from the Treasury Department or the IRS about any potential relief from the timeframes. Now, what is our recommendation? Our recommendation is do your exchange as normal, okay? Submit your ID letter on day 45 when it is due. And then if and when we get an extension, you want to resubmit your ID letter using the extension date. If you are close to day 180 of your time frame, do not obtain a refund until the IRS announces the relief program, or until you need that money, right? You don't want the money sitting in the exchange account forever. So if you absolutely need to get those funds, go ahead, cancel your exchange, pay your taxes, and get those funds. But if you want to hold out some hope that you're going to get relief, don't access those funds, okay? So at best, what we're doing is we're giving you some guidance, and hopefully we will have some really good news for you shortly regarding the time frames. Okay, and hopefully an extension of those timeframes for 1031. All right, so that's my update for the COVID-19 situation right now. Unfortunately, not the best of news, as we are still waiting to hear from IRS and the Treasury Department. All right. Now, I've had a couple people say that they can't hear me, which I'm shocked. I got 100 plus people on the phone call. I think most of you can hear me. So if you can hear me, if someone can ping me and let me know you can hear me, that'd be great. Okay, let's go ahead and get started with today's 1031 exchange webinar. Perfect. We do have people that can hear me. So first thing I'd want to do is I want to let you know who I am. Okay, my company is a 1031 exchange accommodator, and I've done these webinars before where I've gotten off the line and people said, "Hey, Leonard, what does your company do?" Well, we are a required part of the 1031 exchange process. You cannot do a 1031 exchange without working with a 1031 exchange accommodator. We do not sell real estate. We do not sell titles, insurance. We do not do escrow. What we do is work exclusively with investors who are doing 1031 exchanges. And the three things that all exchange companies do are listed on your computer screen. Number one, we hold all of the sale proceeds. All right. When you do a 1031 exchange, you cannot touch your money. Think of it like your 401k program. You have to work with a specific custodian to hold the funds. There's rules on when you can access those funds if you want those dollars to be tax deferred. Same thing with the 1031 exchange. All right. You have to work with a company to hold the money coming out of your sale property. We also provide all of the legal documentation that is required to properly document the transaction as a 1031 exchange. And then most importantly is that we ensure that you are in compliance with the tax rules that regulate or govern 1031 exchanges. All right. So that's what my company does. Now, we've been doing this for a long time. I've been in the business for about 20 years. I started this company way back in 2016. My company is licensed, we're bonded by the insurance companies, and we carry errors and omission insurance. My business partner is a tax attorney who is a member of the State Bar and the California Board of Accountancy. And then very important, one of the things that sets my company apart from our competitors is that we provide audit support in the event of an IRS audit. Now, why is that important, ladies and gentlemen? Well, it is important that you work with a company that's going to help you if you get audited, because when you get audited, you have to prove to the government that you followed the rules. Now, what happens if the government says, hey, you didn't follow the rules? Well, they're going to disqualify your 1031 exchange. They are going to make you pay your back taxes. They're going to possibly penalize you with interest and fines. And then in the most egregious of circumstances, ladies and gentlemen, you could possibly go to jail for tax fraud related to your 1031 exchange that failed. Don't believe me? Take a look at your computer screen. Okay, I have pulled up a screenshot from the United States Attorney's Office. This was a press release that they put out several years ago about a real estate agent named Cheryl Savage, who was sentenced to 14 months in jail for tax fraud related to her 1031 exchange. Let me tell you what Cheryl did, ladies and gentlemen. Cheryl sold a property, and she didn't want to pay taxes on the $750,000 of gain in the properties that she sold. So Cheryl, being a real estate agent, she was aware of 1031 exchange and the fact that she could defer the taxes provided she went out and completed the exchange. The problem with what Cheryl did was when Cheryl did her exchange, she sold the property and she purchased a primary residence. Okay, that is not allowed. And Cheryl knew that you could not sell a rental property and exchange into a primary residence. So what Cheryl did was she falsified her tax returns to make it look like the property she bought in the exchange and was living in was a rental. So she falsified her tax returns to show rental income on the property she was living in because she wanted to call it a 1031 exchangeable property. Ladies and gentlemen, that is tax fraud. And you do that and you get caught, well, that can land you 14 months in jail. So you'd be surprised. People ask me about doing this kind of situation all the time. People say, well, geez, Leonard, I don't want to pay taxes, but I don't want to buy a rental. What I really want to do is buy a home to live in. So can I make it look like the property's a rental by renting it out to my brother and then just living it on my own? Absolutely not. That's tax fraud. Don't do that, right? When you do a 1031 exchange, you have to sell a rental and you have to buy a rental. Now, could I rent the property out to my brother and have my brother pay me fair market value rent? Absolutely. Can I rent it out to my brother for 2 years and then kick my brother out and then can I move into it? Yes, you can do that. But the property that you buy originally must be seasoned as an investment And what I want to see is 2 years of rental activity on that property before you do anything else with it. So you can accomplish buying a primary residence in a 1031 exchange, but you have to be smart. Do not falsify your tax returns like Cheryl did. Just get a legitimate tenant in the property and season them in that property for 2 or more years. And then after that, after you've seasoned the property and you've qualified for the 1031 exchange, then at a later point, if you want to move in, can you do it? Sure. You just need to be smart. All right. Now, I'm guessing many of you are real estate agents. That's why you joined this webinar. I'll tell you what, ladies and gentlemen, if you're doing your own deals as a real estate agent, you want to be very careful because the government holds you to a higher standard. You're supposed to know how to do these things, right? You took real estate principles, you have a real estate license. If you're out there not doing your 1031 exchanges correctly, the government's not going to look kindly upon that. So if you're a realtor, make sure you're doing these properly. All right. One of the things that the government held up in court against Cheryl Savage here was that on her business website, she was describing herself as knowledgeable in 1031. The government actually cited that in court. Okay. And they said, hey, listen, this lady's out there telling the public that she knows how to do these exchanges. And when it came to time to do her own exchange, she didn't follow the rules. Ladies and gentlemen, that landed Cheryl in jail for 14 months. All right. So what I want to do by bringing this up is simply illustrate the point that this is important stuff, right? People go to jail for tax fraud related to 1031s. So you need to make sure that you follow the rules. And of course, my company is here to help you to make sure that you are aware of those rules and to make sure that you're in compliance. Okay, one of the biggest things that we do is just educate our clients on what is possible, what they can get away with, and what they absolutely should not even try. All right, so that's one of the things that we do on a daily basis is to really help you guys navigate these uncharted waters. Okay, so let's talk about a few of the deals that my company has worked on because they illustrate some interesting points about the 1031 exchange process. So let's take a look at the first property here on the board. This is a $42 million property that sold several years ago. It had 3 LLC owners, very complicated transaction. But the reason why I talk about this property here is because when the seller sold this property, they had $30 million coming out of the sale of the property. That's a lot of cash. And one of the first questions they asked me was, hey, when we sell this property, we've got $30 million coming out. Can we take that money and invest it in the stock market until we find our replacement property? What do you think? Okay, you guys have been on this conference call now for about 5-10 minutes. Can you take your $30 million and invest it in the stock market while you're doing a 1031 exchange? Absolutely not, right? The very first thing I said, or one of the very first things I said at the beginning of the presentation is when you do an exchange, you cannot touch your money, right? The government does not allow you to be in constructive receipt of your sale proceeds. If you touch the money, it is taxable. I've actually had clients who've called me after they've closed escrow, and escrow sent them a check or wired them the cash. They called me 2 or 3 weeks later and said, hey, Leonard, I heard I have 180 days to do an exchange. Can you help me with the rules? Well, if you've already closed escrow and you are in receipt of those funds, you don't have an exchange. You're a taxpayer at this point. So very, very important, whether you're doing a $300,000 deal or whether you're doing a $42 million transaction with $30 million in cash coming out, don't touch those funds. Get the exchange account set up prior to the close of escrow. Now, most of my clients will set up their exchange account with me the day they open up escrow, but you don't have to. I have some clients who don't even know they want to do an exchange until their CPA tells them, hey, you've got a huge tax bill. You're closing tomorrow. If you don't do an exchange, you owe $250,000 to the government. They call me in a panic. We set up the exchange account the day before they close escrow. That's fine. Make sure you get your exchange account set up before you close. Very, very important. All right. So, second property here that I like to talk about is the Sandy Springs apartment building in Atlanta, Georgia. Now, this was a $26 million deal that we worked on. And the interesting thing about this property was that it was owned by 27 individual people. All right. So think about that. You get into a real estate deal, you've got 26 partners. 27 people total own the property. When the property is sold, guess what? Every single taxpayer who owns that property can do an exchange. And guess what? If 26 people decide not to exchange, you, as the 27th owner, can still conduct an exchange. Because what happens when you own real estate is that the taxpayer who owns the property is eligible to do an exchange or not. And in this case, we had 27 individual taxpayers who were on title to the property. Now, what happens sometimes, though, is sometimes things get complicated because people don't take title in their name. Sometimes what happens is people will take title in an LLC or a partnership. And if an LLC is on title to the property instead of the 27 individuals, when that property sells, guess what? The LLC is the taxpayer that is eligible to do the exchange. So the LLC will have to sell the property, and the LLC will have to buy replacement property. And that's fine and dandy as long as all of the members of the LLC want to do the same thing. Now, if you have 27 people who own a property, how likely is it that all 27 want to do the same thing? It's highly unlikely. So what happens a lot of times when you have these partnerships and LLCs that are created, you're going to have to many times dissolve them before the sale so that the individuals can do their separate things. And that's important. If you're a real estate agent, especially if you're working on a very large transaction, $5, $10, $20 million deal, if you pull up the title report and you see that the property is not owned by individuals, but it's owned by a partnership like an LLC, you're going to want to ask those people, hey, do you want to do an exchange? And if so, do you want to do it together? Or are the members going to go their separate ways? If they're going to go their separate ways, it's very, very, very important that that partnership is dissolved prior to the sale. And each of the individual members of the partnership goes on title to the building or the property prior to the sale. Because what we want to have is the individual taxpayers on title so that the individual taxpayers can exchange separately. Does that make sense, ladies and gentlemen? Because that is important. All right? It is the taxpayer who owns the property that is eligible to do the exchange. You may have one taxpayer or you may have 27. And it's very important for 1031 exchange to know who the true owner of the property is. I see this all the time with trusts and LLCs and partnerships. And sometimes it causes a problem because people don't dissolve those partnerships prior to the sale, and then the LLC ends up paying a big tax, of course, that is passed through to the members. So the taxpayer who owns the property is the taxpayer who can do an exchange. Important lesson to learn from this property here. All right, and then finally, we've got the Armory building in San Francisco, California. The reason why I talk about this property was because it was the largest property that sold a couple years ago in San Francisco. We were lucky to be able to work on this transaction. And what was unique about this property was it was owned by one person through an LLC, and that one person through his LLC went out, did an exchange, and bought 30 replacement properties. So I get asked all the time, well, geez, Leonard, can I buy multiple properties in an exchange? Absolutely. You need to know the rules and how to do it, but you don't have to just go out and buy one replacement property. You could buy two. You could buy 30. You've got a lot of flexibility in how your exchange can be structured, but you do need to make sure that you follow the rules that we're going to talk about here shortly. Now, why do people do exchanges? Okay, in my advanced class, I spent a little bit of time on this because this is very important. All right. People do exchanges because they don't want to pay taxes. Everybody knows that, right? But did you know that if you cash out and you choose not to exchange, about 1/3 or 33% of your gain goes to the government? I'm going to show you how to calculate your tax bill in the next slide. But did you know about 1/3 will go to the government? People do exchanges because they don't want to pay their taxes, right? They don't want 1/3 of their wealth going to the government. They do exchanges because they want to build wealth through real estate. And the fastest and the best way to do that is to keep the money that would have gone to Uncle Sam in your pocket and trade into bigger and better properties. Okay, real estate is fantastic. It's the most tax-advantaged investment out there. Think about it. If you sold your Google stock, you got to pay taxes no matter what. But if you sell your investment real estate, there's an opportunity for you not to pay taxes as long as you do an exchange. And that is going to keep all of your money working for you and get you into bigger and better property. Now, some of my clients are already very wealthy and they already own a ton of property. Those people will do 1031 exchanges because they want to protect and preserve their wealth. And the best way to do that is to diversify, right? Think about it. If you own $20 million worth of real estate in San Francisco and there's an earthquake, all of your property might slide into the ocean. Well, if you want to protect and preserve that wealth, a way to do it is to go and diversify into different geographies or different types of real estate or both. All right, so I have a lot of investors who are simply looking to protect and preserve their wealth, and the way to do it is with a 1031 exchange and diversify into different areas or different property types. Now, the last reason why people do exchanges has to do with time, and two things happen over time when you own real estate. Number one, you get sick and tired of it, and number two, the properties that you own become fully depreciated. All right, ladies and gentlemen, those are both fantastic reasons to consider an exchange. You've got a 20-unit apartment building, and you are sick and tired of the terrible T's, right? You've got toilets and tenants and trash and termites to deal with. Well, think about this. Why don't you exchange out of your really tough to manage properties and into something that's easier to manage? Okay, this is the number one reason why my clients do exchanges when they're older. Right? Most of my clients, they're not 25. A lot of my clients are in their 30s and 40s, but the bulk of my clients are 50, 60, 70 years old. And a lot of those clients are choosing to exchange simply because they want to get out of tough to manage properties and into something that's easier to manage. They want to spend less time with their grandkids and more time with their tenants. Less time with their tenants and more time with their grandkids. I had that backwards. All right, so think about these reasons, ladies and gentlemen. These are reasons why people do exchanges, and what I want you to do during this quarantine, shelter at home, stay in place kind of time is go through your Rolodex and think about people who you can have conversations about 1031 exchange who might want to buy more property, who might need to diversify, who might need to make their life easier. Okay, there's a lot of realtors sitting around watching Netflix and eating ice cream right now. If you are a realtor who thinks about your clients and how they might benefit from an exchange, when this whole thing is over, you're going to do a whole lot more deals than everybody else. All right, so these are reasons why your clients will do an exchange with you. They will list and sell and buy replacement property because of these reasons. Now, Let's talk about the main thing, all right? The main thing in doing a 1031 exchange is you don't want to pay taxes, right? And a lot of people just don't know what their tax bill is. I talk to clients all the time who say, well, geez, Leonard, I don't mind paying taxes. It's only 15%. Wrong. Okay, 15%, ladies and gentlemen, is the starting point. If you have income over 400 or 450,000 married, your tax bill goes to 20%. You also have to pay taxes on your depreciation. You have a depreciation recapture tax of 25%. And finally, a Medicare tax at 3.8%. All right, so when people tell you, oh, it's only 15%, they are dead wrong. Okay, and that's just the federal taxes. My company is headquartered in San Francisco. We're in California. Okay, and California has their own taxes, as do most states. Now, of course, there are exceptions, but here in California, we start out at 9.3%, and the tax rate that you pay California goes up as your income goes up. So the rule of thumb is when you look at all of these taxes that you're going to pay between the state and the federal government, you've got a tax bill of about 33%. Now, of course, if you're in Texas, it's going to be a little bit lower. If you're in New York City, it might be a little bit higher. But the rule of thumb is about a third of your gain goes to the government. Now, notice I said a third of your gain. How many of you know how to calculate your gain? Well, it's pretty easy. The way you calculate your gain is you take your net sales price and you subtract your adjusted basis. Well, of course, that's going to beg a few questions. Well, geez, Leonard, what the heck is my adjusted basis? Well, my adjusted basis is the price I purchased my property for minus my depreciation plus my capital improvements. So let's do a quick example on how those calculations are done. All right, let's assume I bought a property for $500,000 way back when, and I've taken $100,000 of depreciation over the time I've owned it, and then at one point I had to put a new roof on, and that's a capital improvement, and that cost me $25,000. I am now in contract to sell my building for a net sales price after commission and closing costs of $1 million. And please note, ladies and gentlemen, I said net sales price after commission and closing costs. So I was in contract for $1.1 million, but I had $100,000 of commission and closing costs to pay. So my net sales price is $1 million. Right? So we're always going to reduce our sale price by the commission and closing costs to get to our net sales price. All right? So let's do a little bit of math over here on the left-hand side to figure out what our gain is going to be. The first thing we need to do, though, is calculate our basis. And if you pass second grade math, you should be able to follow along. We've got a purchase price of $500,000. We're going to subtract out our depreciation, and we're going to add back our capital improvements to get a basis of $425,000. Using our basis, we're going to calculate our gain very easily. $1 million minus our basis gives us a $575,000 gain. Ladies and gentlemen, one of the things that is very important to note is that nowhere in any of these calculations do we see anything related to the loan. All right? Your debt or your loan does not factor in to your tax bill at all. So a lot of people say, well, geez, Leonard, I'm going to sell for $1 million, but I owe $1 million. So I'm not going to have to pay any taxes, right? Wrong. The debt you hold against your property has nothing to do with your tax bill. All right? All we care about is your net sales price and your basis. That gives us your gain, and then we apply all of those taxes that I mentioned earlier against your gain to figure out what your tax bill is going to be. Now, in this case, you're going to have almost $200,000 worth of taxes to pay if you sell this property. And ladies and gentlemen, this is a very, very common situation. Like I said, I'm in California. So people with $200,000, $300,000, $400,000 tax bills, that's every single day. You don't have to pay that tax bill though. The great thing about real estate is the most tax advantaged investment there is. So the great thing is that you might not have to pay that tax bill. Okay? The great thing is that when you sell real estate, there are fantastic tax breaks available to you, and the type of tax break you get depends on the type of real estate that you sell. Now, my whole life, my whole company, my whole professional life is dedicated to helping people do 1031 exchanges. And that is the tax break you get when you sell investment or business use property. And the tax break that comes along with 1031 exchange is a deferral. All right? You can defer taxes on the sale of your investment property if you qualify for 1031. But that's not the only tax break that's out there. Okay, most of you are also very familiar with Section 121 of the Internal Revenue Code, which is the tax break that you get when you sell your primary residence. This tax break allows you to avoid paying taxes as long as you have lived in your home for 2 of the past 5 years. Now, if you're single, the first $250,000 of gain is tax-free, and if you're married, the first $500,000 of gain is tax-free. This slide right here is very important because every single real estate professional on the call is going to work with clients who are either selling homes or selling primary residences. I mean, selling investment property, right? You're either going to sell a property that someone lives in or you're going to sell an investment. There are a few other types of properties that you might sell, right? You might sell a vacation home. You might sell a second home. But most of the properties you're going to sell are going to qualify for either the primary residence homeowner's exemption or the 1031. Okay? And there are some properties that you will sell where your client can take both the homeowner's exemption and the 1031 exchange together. So let me give you an example, ladies and gentlemen. You have a client that is selling a 2-unit building. All right, take a look at your computer screen. The client lives in the top unit and they rent out the bottom. This is one sale to one buyer with one escrow. But your client can take both the homeowner's exemption and the 1031 exchange on this one property because there are 2 uses to that property, right? The property is used both as a primary residence and a rental. So we can apply both tax breaks to the sale of this building. This happens all the time, okay? It doesn't have to be a 2-unit building, okay? I had a client who had 60 acres out in the Central Valley. It was a dairy farm. They lived on the dairy farm, right? Their house was there, so the value of the house got the homeowner's exemption, but the value of the 60 acres was all investment business activity, so they did a 1031 exchange on the value of the 60 acres. It was a $5 million sale, and my clients walked away paying 0 in capital gains tax. There is tremendous opportunity when you understand how these tax laws work. Let me give you another example, ladies and gentlemen. Let me give you a very, very interesting example here, okay? And this is our advanced class. So, I apologize if I'm going fast and I'm talking a lot about these really interesting complex ideas, but this is our advanced class, so we're going to presume you have a basic knowledge about 1031 exchange. And we're going to throw a lot of really cool ideas out at you right now, right? And one of those cool ideas is this, okay? And we're talking about the homeowner's exemption and the 1031, using them together. Here's one of the greatest ways that you can do that, okay? Imagine if you bought a home in Palo Alto 30 years ago and you paid $100,000 for it, okay? You've lived in that property for 30 years, okay? Now the property is worth $5 million. And you say, you know what? It's worth $5 million and I want to sell it. The problem with this is you've lived in the property so long and the property has appreciated so much that even with your homeowner's exemption for a married couple, you've got $4.4 million worth of gain to pay taxes on. So if you sell the property right now for $5 million, you're going to have $1.3 million in taxes to pay. You've got a really good property in a really good location, but you've got gain in excess of your homeowner's exemption. So what do? Well, here's what you do, ladies and gentlemen. You don't sell that property as your primary residence. What I want you to do is I want you to move out of the property and I want you to rent it out. Okay? I want you to establish that Palo Alto home as a rental for 2 years. And then I want you to sell the property. And let's say it doesn't appreciate at all. Okay, no big deal. It still is worth $5 million after 2 years. But the fantastic thing about this is now it is eligible for 1031 exchange. All right. The property is a rental at the time of sale, so it qualifies for 1031 exchange. Fantastic. But because you've also lived in it for 2 of the past 5 years, it is also eligible for your homeowner's exemption. Ladies and gentlemen, you have a $5 million property where you can apply both the 1031 exchange and the homeowner's exemption. You can walk away from that sale paying absolutely nothing to the taxman. Here's how it works, okay? The first $500,000 is going to come out of the property completely tax-free. You put that money in your pocket and you pay nothing on the first $500,000 of cash that comes out. The remaining value of $4.5 million is now going to qualify for 1031 exchange. As long as you go out and you do a 1031 exchange on that $4.5 million worth of value, you now have deferred all of the remaining tax liability. Did I just blow your mind? Did I just show you how to save your clients $1.2 million in taxes? I did. Okay? It is people who understand how these tax laws work, but how you can use them together that are walking away from these highly appreciated properties without paying nothing, a dime to the government. That is fantastic. Okay? Now, I have an article that discusses exactly how to do that. So if you want to walk away from this seminar with something in your pocket that you can take to a client and say, here, read this article, we can provide you with that information. Now, before we move on to the next few slides, I do want to tell you that one of the things that is very important to note about 1031 exchange, unlike the homeowner's exemption, is 1031 exchange is not tax avoidance, it is tax deferral. Now, what does that mean? Well, let me give you an example. I have a client who's going to 1031 exchange out of a 2-unit building and go into a 4-unit building. Okay. They don't pay taxes because the tax bill is deferred. You sell the 4-unit and you go to a 10-unit. Once again, the tax bill is deferred. You sell the 10-unit and you exchange into a 20-unit building. Guess what? Tax bill is deferred. The problem with 1031 exchange is that once you decide to sell the property and cash out and stop exchanging, you have to pay the tax bill. Now, You might have done all of these deals over a series of 30 years. So this has been a fantastic opportunity for you because over the 30 years of investing and doing 1031 exchange, you have used money that should have gone to the government to build your wealth, right? A lot of people look at 1031 exchange as a temporary loan from the government. Say, hey, it's the government's money. We know it's just a deferral, but we get to use it until we cash out. And ladies and gentlemen, what happens when you cash out is you pay the taxes on your on your ultimate sale, but then also all of the transactions that preceded it. Right? The tax bills don't go away. What happens is you build a snowball of taxes that gets bigger and bigger with every successful transaction. So if you sell that 20-unit apartment building, you pay all of the taxes from all of the previous transactions. Now that's a bummer, right? You sell this 20-unit apartment building and you might owe $2 million in taxes. I'm going to argue that that's a good thing. Okay, it's a good thing because you've been very successful. If you have a $2 million tax bill, well, geez, you've made a ton of money. But how many of you are out there thinking, yeah, I don't want to pay that? Probably all of you, right? Nobody wants to pay $2 million to the government. So what do? Well, here is what I'm going to tell you to do. All right. This is a very popular strategy in the 1031 exchange world. Write it down. It is the 3 Ds of investing. All right. When you are a 1031 exchange person, you want to remember the 3 Ds. You're going to defer, and then you're going to die. You're not going to sell. You own real estate until you pass away, and then when you pass away, ladies and gentlemen, that tax bill dies with you. How many of you own real estate? Most of you? Don't sell it. Just keep exchanging it. Exchange it until you pass away, and then when you die, your children will inherit that property at a step up in basis. If your basis is really, really low, $100,000, and the property is worth $5 million, well, the difference is the gain. And that's taxed, right? So you've got $4.9 million of gain that's taxable. Well, if you kick the bucket and you die, the tax basis in the property steps up to $5 million for your heirs, for your kids. They can go out the day after your funeral and sell the property and pocket all of the cash without paying a dime to the government. So a couple important lessons that you can take away from this webinar. All right. You can use 1031 exchange together with the homeowner's exemption, and you can defer, die to completely eliminate your tax liability. Now, you're thinking, well, geez, this isn't good for me. I want to have some cash. All right, well, you've got a 20-unit apartment building. Go ahead and refinance that building. Pull some equity out. You want to buy a Ferrari? Do it. Don't sell the building and pay taxes to get the money. Just get an equity line against the property. Refinance it. A refinance is a non-taxable event. So for those of you who want to get your cash, you've got a way to do it. All right? So there are strategies that you can employ that are very smart that will save you hundreds of thousands of dollars in tax liability. Now, of course, you're going to need to know how to do exchanges, and most of you already do. All right? Most of you took my basic webinar class, and you don't need to go over all the fundamentals of how to do an exchange, but real quick, we're going to talk about them. Okay, I'm going to go through these very, very quickly. Number one, need to make sure your property is qualified. Now, I talked about this in the beginning. You can only 1031 exchange investment or business use property. Foreign property doesn't qualify, and quick flips don't qualify. I also want to make sure that you've owned the property for 1 to 2 years. If you're in California, I want to see a 2-year hold because California is a little bit more aggressive with their auditing. All right. So what we don't want to do is we don't want to exchange something that we've owned for a very short amount of time. The government looks at time as one of the factors to consider on whether your property is eligible or not. So the longer you have it rented out, the better. All right. So make sure your property is qualified. Rule number 2. If you do an exchange, you have to reinvest all of the cash and purchase property equal or greater in value in order to defer all of your taxes. If you sold the building for $1 million, you need to buy replacement property for $1 million or more. Now, that could be 2 properties, right? You could sell 1, buy 2. You could sell 4, buy 3. You can do multi-property exchanges. That's not a problem. You can also trade down in value. If you sell for $1 million and you buy for $950, it does not negate the entire benefit of the 1031. You simply pay taxes on the difference. All right. So if you don't want to pay taxes, reinvest all of your cash and purchase property equal or greater in value. Rule number 3. When you do your 1031 exchange, get it done on time. All right. So right now, without any guidance from the IRS on extensions, you need to get your deal done within 180 days, and you need to identify on day 45. As I mentioned in the beginning of the presentation, we may get an extension on our time frame. Now, we may not. The IRS is likely to provide extensions because we've got shelter in place, right? People aren't going out looking at properties. So it makes sense for the government to extend these time frames because of this ridiculous coronavirus situation we're in. But if they don't, you still need to adhere to the regular time frames. All right. And as soon as we hear from the IRS on an extension, we will let you know. We've got you registered now. We're going to blast out whatever we hear from the IRS the moment we hear it. Okay, so we're holding hope. We got our fingers crossed. Hopefully, we're going to get some taxpayer relief on these time frames coming soon. But right now, if you are in an exchange, you still need to identify on day 45. And as I mentioned earlier, if we get taxpayer relief, you can resubmit based on the new extended time frames. Now, how do you identify? Real quick, you're going to fill out your identification letter. All right. The identification must be done in writing. So you're going to fill out this letter here that we provide you. And when you do it, you're going to use either the 3 property or the 200% rule. What's the difference? Well, pretty simple. With the 3 property rule, you can identify 1, 2, or 3 properties. That's it. And when it comes down to your exchange, you have to buy 1 of the 3, 2 of the 3, or all of the 3 properties that you've nominated. On day 45, once you've locked in your properties, you've got to buy from that list. You can't make substitutions or changes after day 45. Now, if the government gives us more time frame, that's a different story, right? But in a normal environment, if on day 46, property number 1 burns to the ground, you can't replace it. On day 47, if property number 2 gets sold to someone else, you can't replace it. You've got 1 property left on your list, and that's the property you need to buy to complete your exchange. The 3 property rule gives you 3 bites at the apple. Now, I mentioned in the beginning of the presentation, I had one client who bought 30 properties. Well, how the heck did he do that? Well, he didn't use this identification rule. If you want to buy 4 or more properties in your exchange, when you identify, you have to fill out your identification using the 200% rule. The 200% rule does not limit the number of properties you can identify. However, you have a limit on the value. All of the real estate, when you add up the values, it cannot exceed 200% of what you sold. So, if you sold a property for $1 million, you can identify $2 million worth of real estate. My client, at the beginning of the presentation that I talked about, he identified $130 million worth of real estate because he sold for $65 million. So if your goal is to buy 4 or more properties, this is the rule that you're going to use. Make sense? Okay, those 4 guidelines, I can get into a lot more detail on a lot of stuff, but we're covering some pretty advanced topics here, and I've only got a few moments left. And what I want to do, we talked about this already. What I want to do is I want to talk about the reverse exchange, because people always say, well, geez, Leonard, what about a reverse? Well, a reverse exchange is when instead of selling and then buying, you do the opposite. You buy first and then you sell. All right? And many of you might be thinking, well, geez, maybe during this whole situation, I can go out and get a good deal, buy something now, but then I'll put my property on the market in 2 or 3 months. Yeah, you can do that in an exchange, but it's challenging. All right? In an exchange, you are going from one property to another. You cannot own 2 properties at the same time. So a reverse exchange where you buy first requires me to become the straw buyer of your property. So a reverse exchange where you buy first actually gets me involved as the buyer. I'm going to take title to the new property for you. I'm going to lease it back to you so that you have all the burdens and benefits of ownership. And then you only become the owner of this property when you get yours sold. So a reverse exchange, ladies and gentlemen, allows you to actually buy first and then sell. But the problem is you can't own them both at the same time. So I become the buyer of this property for you. I lease it back to you, and then I give you control of this property once you get your building over here sold. That's a reverse exchange. Reverse exchanges are challenging for a variety of different reasons. Number one, I'm the buyer of this new property for you, but I'm not using my money to pay for it. Heck no, right? So you still have to pay for the building. You haven't sold yours yet, so do you have money available to buy this building? Oh, no problem. You're going to get a loan. Well, guess what? Lenders do not like to loan you money when I take title. So if you're going to go to a traditional lender like Wells Fargo or Bank of America and say, hey, I want to do a reverse exchange and Leonard's company is going to take title for me until I get my sold, their underwriting department is going to say, nope, don't want to do it. So financing a reverse exchange can be very challenging. Most of my clients who do reverse exchanges will have the cash to pay upfront without a loan, or they will work with a hard money lender who's going to offer them very flexible terms, but at a very expensive rate. The final thing that I don't like about reverse exchanges is, ladies and gentlemen, when I become the owner of this property for you, there is a transfer tax to pay. All right? And depending on where you are, that can be expensive. And you're thinking, well, no big deal. There's always a transfer tax, right? Well, yes, there is, but there is a transfer tax when I become the buyer, and then again when you become the buyer or the owner. So you've got 2 transfer taxes on this property. So reverse exchanges work, yes, absolutely. But because they're so complex, they're more expensive. The fees are higher. From my perspective, I'm taking on a lot more risk and liability, so I'm going to charge you more to do a reverse exchange. You're going to have duplicate transfer taxes, and you're going to have duplicate escrow and title. Okay, so if you can shell out the money to do the reverse exchange, it will absolutely work for you, or if you don't mind shelling out the money. A lot of people say, you know what? I don't want to deal with the extra $30,000 that this is going to cost me, so I'll just do a regular exchange. So a couple things to consider on the reverse. Is it worth the effort and the extra expense to make sure that you secure your property up front? For many people, that answer is yes. All right. But I want you to have all the information before you go out and talk to your clients about, oh, yeah, reverse exchanges are easy. Let's just do reverse. No, it doesn't work like that. Let's do a conference call to talk your client through how they work before you tell them that it's a viable solution. Because I've had realtors who told their clients, oh, we'll just do a reverse exchange. It's not a problem. And then when we walk through all of the fact patterns and how these work, the client was actually really upset with the realtor. Said, oh, you told me this was going to be no problem. Reverse exchanges are an option, but they are definitely a more complex option. All right, ladies and gentlemen, my watch says that we are out of time. So what I'm going to do is I'm going to go ahead and wrap up. And we talked about a lot of kind of advanced situations. Now, there's a million other things I could talk about. I could talk about related party rules, and I could talk about seller financing and a million different things. But this was a great class because we talked about, I think, some of the most advanced topics that are pertinent to how you guys do business. All right. There's a lot more that we could talk about, but to be honest with you, a lot of the stuff just doesn't come up very often. What we covered today, I think, is practical stuff that you're going to see and use in your dealings with real estate. So the reason why we do these classes is because we want to be your accommodator. The market's going to stabilize, whether it's next month or 2 years from now, who knows, right? But you're putting in the time now to learn these techniques to build your business. So congratulations to you. We want to be part of your business plan. If you have an exchange that you're doing right now, please, please, please send it over to us because, there's not a lot of deals right now. So anything we can get is fantastic. If you have questions, give me a call, shoot me an email. I know that there are questions here that have popped up, and I'm going to go ahead and answer these questions right now. Okay. So if you need to go because you've got to go homeschool your kids, by all means, take off. If you need to go for a walk, have a good walk, but shelter in place, do your part. Right? You don't want to get my grandma sick and have her die. So please do be safe. I'm going to answer all of these questions here that popped up on my computer screen though right now. So I'm going to start with Linda says, where are your headquarters? Well, I think I answered that. We're in San Francisco and we have offices in Southern California and Florida. We do deals nationwide. Absolutely. Alice wants to know, what if the rental property, okay, don't know Alice's question. So Mong Ling wants to know, what is the minimum requirement for rental? Okay, in a 1031 exchange, the government doesn't tell us the absolute minimum time a property must be rented out, all right? But from audits in California, I'm going to tell you 2 years to be safe. Now, can you get away with less? Absolutely, because the government in an audit looks at a variety of factors. Time is one of those factors, but also your intent is going to carry a lot of weight. So if you put a tenant in there and 8 months later, the tenant didn't pay rent and skipped town, and now you can't re-rent the property because of the coronavirus situation, and you need to sell it or you need to move in, well, the government's going to look at those extenuating circumstances. So time is definitely one factor that they look at, but it is not the only factor. All right. Alice wants to know, well, can I exchange into a duplex and live in one part and rent out the other? Absolutely. But guess what, guys? And this is something we didn't talk about. If you do an exchange, you need to replace the value of the property you sold. All right. So you've got a rental here that you sell for $1 million. You want to do an exchange into a 2-unit building and you want to live in one of the units. That is absolutely fine, but you have to replace the value of your investment property with another investment property equal or greater in value. So you buy a duplex, the unit you rent out must be worth $1 million. Now, if you buy a 2-unit and it's worth $2 million and you rent out half of it, that works. But if your duplex is only worth $1 million and you rent half of it out, that's not going to work. So remember, you can live in a portion of the property you buy in an exchange as long as the portion that you rent out satisfies your 1031 requirement. Linda says, what does TIC stand for? TIC is tenant in common. It is the preferred method of owning real estate with a partner. Can you sell 3 properties and buy 1? Absolutely. All right. The thing about selling 3 properties and doing an exchange into 1 is your time frame starts when the first sale closes, right? So you have 180 days to go out and complete the purchase of the replacement property and get the other 2 properties sold. Tony says, when do these deferred taxes get collected? Well, we talked a little bit about that, right? When you cash out. How about if a person doing the exchange is no longer alive? Well, then the heirs get the stepped up basis, right? Okay, I think we talked about a lot of these questions here. I read that states like California are tracking 1031s when they roll out of the state. Is that true? Absolutely. So take a look here at the computer screen. You're going to do an exchange out of California, and you're going to go buy replacement property in Texas and Arizona. Guess what? You just took taxable money from California and you sent it out of state. So the government in California requires you to let them know every single year that you have an ongoing exchange. If you do not let them know, they're going to assume that you sold your out-of-state properties and make you pay taxes. So you have to file a form with California letting them know every single year that you have an ongoing out-of-state exchange. And when you cash out, they want you to pay taxes on the gains that left California. Very good question. California is aggressive, right? They say, hey, you made money in California. We want the taxes when you eventually cash out. Eric says, can you do an exchange into U.S. territories? Yes, you can. Certain territories qualify. Guam, Puerto Rico do qualify. Okay, John Lee says, well, geez, we had a client who exchanged into 30 properties. How was that possible? Well, remember, they used the 200% rule to identify those properties. All right, so 2 methods for identification. Shiva says, well, geez, what if my plan changes before day 45? That's fantastic, right? Who cares what you do in the first 45 days, right? So you don't have to identify until day 45. So in the first 45 days, you can make 200 offers on 200 different properties. That is not a problem. All right, so Tony wants to know, can the transfer taxes be paid with sale proceeds? Absolutely. So there are certain things that you can pay with your sale proceeds. Transfer taxes, commissions, closing costs, those all can be paid with your 1031 exchange tax-free or tax-deferred dollars. All right, just chugging through a lot of these questions here. Some people have left. Okay, so Blair wants to know, when you are taking the homeowner's exemption, your basis is increased by your improvements, right? So we went over how to calculate your basis, and your improvements are absolutely calculated in your basis and will help you out from a tax perspective. Geez, we have a ton of questions here. Okay, after day 45, you cannot change your identification letter. And Jill says, my exchange was rented for 12 months. When she moved out, I discovered dry rot issues. Due to conflicts with the other condo owner association, I have not been able to re-rent. It's been vacant for 11 months now. Can I move into the unit and rent my primary, or will this be considered a failed exchange? Jill, you are going to be in a tricky situation, right? Because you already have a house. And if you want to sell that one and move into your 1031 property, the government's going to say, well, geez, why'd you do that? And you're going to have to argue, well, I couldn't re-rent it, and the coronavirus situation was very difficult for me. And I think you'll have a case. But the IRS may challenge you, but you might never get audited. All right. So if you are in a situation right now because of the coronavirus where you need to move into your 1031 properties, I think you're going to have a very compelling argument if you're ever audited. But here's the kicker, ladies and gentlemen. You're probably not going to get audited. All right. About 5% of my clients every year get audited. And usually it's people who are doing $10, $15 million deals, or they're going from California to a different place. So if you need to move into your 1031 properties right now because of this whole mess the country's in with this virus, I think it's going to help you out that we're in such a weird situation. Can new construction be used in an exchange? Absolutely. You can buy a new development from KB Homes, but the property you buy needs to be rented out. Once an owner moves into an exchange property after 2 years, will the property be considered a primary? All right. Once you move into your rental and you've seasoned the property as your primary for at least 2 years, when you sell it, it's going to be considered your primary residence. However, the government is going to prorate the amount of gain you have between the primary residence and the rental. And when you sell the property, only the gain associated with your primary residence use can be sheltered by the homeowner's exemption. Shiva says, is there any extension to the day 45? Yes, there is in disaster situations. Okay, wildfires, hurricanes, possibly COVID-19. We will see. What if I sell for $20 million and I buy for $20 million, but ask the buyer for a credit? A credit is a reduction in the sale price. All right. So if you sell for $20 million and you buy for $20 million, but you get a $2 million credit, you really bought for $18 million. So you didn't satisfy your 1031 exchange requirement. Does it make sense to go through a 1031 exchange for the sale of property that isn't going to generate a lot of gain? Maybe, right? I don't know. How much gain is it? It costs $1,000 to do an exchange. So if you save $10,000 in taxes and you know you're going to buy real estate anyway, yeah, right? It always makes sense to not pay taxes if you don't have to. Can you do a 1031 exchange into a REIT? No. Pricing for the two different types of exchange. Standard exchange, $750 when you sell, $250 when you buy. Reverse exchange, $6,500 plus, depending on the type of exchange you do. What happens if the rental is sold at a loss? Well, if you don't have taxes to pay, you don't need to do an exchange. But again, that's why we talk about how to calculate your basis. Because even if you bought the property for $1 million, you might have gain because of the depreciation, right? So you need to figure out what your basis is before you know whether or not you have a loss or not. Hey guys, I'm going to put you on hold for 2 minutes. I need to text my wife my Chick-fil-A order. All right, just so you guys know, I got the 8-piece chicken nuggets with fries and a Coke Zero. Not that you cared. All right, so let's keep going. if the exchange property is owned for a long time, how do you compute the taxes owed on depreciation? Okay, I think we went over that, right? So your tax on depreciation is 25%. That's the tax rate. And what you're going to do is you're going to add up all of the depreciation you took every single year. So if you took $10,000 worth of depreciation every single year for 3 years, you've got $30,000 in total depreciation, and your tax rate on that is 25%. Can I build my exchange property? Yes, you can, Derry, but you need to get the building done within how many days? That's right, 180 days. So very tough to do an exchange where you build from the ground up. Blair, so if I bought a property for $1.8 million and sold for $1.4, would I be excused on the taxes? Again, Blair, depends, because I don't know how much depreciation you took. But if you sold for 1.8, you bought for 1.8 and you're selling for 1.4, yeah, you've got a $400,000 loss, but I don't know how much depreciation did you take, right? All right. All right, last question, and then we're wrapping up. Shiva, if something happened to the identified property and the owner changed their mind after day 45, would the government allow me more time? No. Nope. No more time after day 45 unless we get an extension because of the coronavirus. All right? All right, I lied. Gretchen says I didn't answer her question, so I'm going to answer. If you have done multiple exchanges over 30 years and don't know how to calculate the depreciation, gotcha. Okay, so depreciation is going to be assumed whether you took it or not. And I'll show you how depreciation works, okay? I've got $1 million property, but the property is composed of land and the building. So I've got $800,000 worth of value of the building and $200,000 worth of land value. All right. So when I bought the property, this was the breakdown. Now, if it is a residential investment property, I can depreciate that property over 27 and a half years, but I only depreciate the value of the building, not the value of the land. Right. So what I'm going to do is I'm going to take my $800,000. I'm going to divide it by 27 and a half to get the amount of depreciation I should have taken every year. All right. So if you didn't take depreciation, or if you don't know because you just weren't paying attention, you can go back to your CPA and you can say, okay, when we bought the property, what did we buy it for? Was it $1 million? And if so, how much of that was the land? We're going to take out the value of the land. We're going to say, okay, what we had available to depreciate was about $800,000, and the way we get the amount of every depreciation we could take every year is by doing a little calculation. All right, ladies and gentlemen, I got to go eat my Chick-fil-A. So thank you all for logging on. For those of you who stuck around for the last 15 minutes after we were supposed to end, I appreciate your time. And please, everyone, be safe. We do webinars all the time. Our next webinar is actually my favorite. It's how to grow your business with 1031, where I talk a lot about the marketing that you can do to investors around this stuff. So if you're an agent, definitely join that one. All right. We send out emails all the time about our webinars. Please don't take my webinar and then use another exchange company. That breaks my heart when you do that. So don't do that. I need your business. Have a great day, everybody, and stay safe, stay healthy, and we'll see you at the next one.